HVPE is a listed company on the London Stock Exchange which gives investors exposure to the very best private equity, private markets managers from around the world. It's managed for us by HVPE partners who are based in London and in Boston with other offices worldwide, and has delivered a fantastic return for shareholders ever since it was first launched.
HVPE Partners is a well-known global private markets manager with more than 40 years experience in the industry as a specialist in private markets. The firm has 13 offices around the world with more than 1,200 employees, including more than 200 investment professionals who together manage assets in excess of $125 billion. HVPE invests only in and alongside the HVPE funds, and in this way gains exposure to more than 500 best-in-class private equity managers at the underlying level.
"2023 was a challenging year for private equity markets around the world, but I'm pleased to say was slightly better than the year before. So HVPE returned to positive growth, both in share price and in net asset value per share. Throughout the year, our shares did trade at quite a significant discount to their net asset value. One of the characteristics of investment companies, including HVPE, is that discounts move with the cycle. And we have had a challenging time for private markets over the last couple of years. High interest rates, sluggish growth, uncertainty about when bond yields might return to levels that we've seen more normally in recent years. And investors have looked at that and wondered what returns might be in the future. And shares have moved to a wide discount to reflect that uncertainty. We are very confident in the valuations that underlie the net asset value of HVPE, and as a consequence, we've been in the market buying back shares and will continue to do so. And what we have decided to do is to earmark a proportion of all the distributions we get from our underlying investments and to direct those into the market to buy back shares through what we're terming our new distribution pool.
In the year just ended, secondary funds led the way in terms of NAV growth, closely followed by direct co-investments. What did lag a little were the primary funds, and that's related to the composition of those funds and the fact that the majority of venture and growth equity exposure is accessed through those primary fund of funds vehicles. In terms of stage, buyouts were the strongest performer, which was very helpful given they're the largest single allocation in the portfolio. But they were closely followed by real assets and credit. We introduced that category as a deliberate offset and to some degree as a hedge against some of the more volatile early stage exposures. So that has played out very much as we hoped it would. In terms of the geographical allocation, we saw perhaps surprisingly that Europe led the way in our portfolio. North America did still perform well. However, the smaller allocation to Asia did deliver a slightly negative return. We don't think that should be read as the start of a trend or be taken in too much significance, because the long-term returns from Asia have been very strong. We have made two sets of changes to the allocations for the next 5-year period. The first is to increase the target weighting to real assets and private credit investments from 10% of the portfolio to 15%. That's been done in recognition of what we perceive as a very attractive risk-reward balance in those investments that, as a reminder, produce a degree of yield on a regular basis and also tend to track either interest rates or inflation or both in some cases. They've delivered a very strong return for the last 2 years in a row and helped to offset some of the perhaps more volatile investments in the early stage companies that we back. We've taken that 5 percentage point increase from the buyout allocation down from 60 to 55%. And part of the rationale there was that many of the real assets and private credit investments are adjacent to the buyout portfolio. There's a more natural fit on a continuum in those assets. On the geography side, we increased Europe from 20 to 24% and took that 4 percentage points from the Asia allocation. We previously had a balance essentially of Europe versus Asia. We now have an overweight to Europe instead, and that is in recognition of some very attractive opportunities we're seeing in Europe. The private equity market has broadened and deepened in recent years, particularly on the venture and growth equity side. Taking that 4 percentage points from Asia is not a reflection on our view of Asia necessarily. It's more a pragmatic consideration around the likelihood of being able to deploy enough capital to achieve the previous target, given constraints in the opportunity set that we're seeing at the moment. It was an unusual year for private markets in general. It was the weakest environment for cash distributions in a decade, and that was reflected in HVPE's portfolio as well. So we saw negative cash flow of $283 million in the year. That was the result of weak distributions, but combined with consistent activity actually in capital calls. So underlying managers were identifying attractive new investments, and of course HVPE was funding those capital calls as required. But we weren't seeing cash come back from maturing investments. So in the year we drew $275 million to fund those capital calls in light of weak cash flow, and we ended the year with a cash balance of $140 million as a result. We have always anticipated that at some stage we would endure a period of negative cash flow, and that is precisely why we've had a large credit facility in place for so long. We have an $800 million total facility size, and so we're drawn by 275, which is a comfortable proportion of that facility. And given we're seeing the green shoots of recovery in terms of M&A and IPO activity, I think we're optimistic that the balance of cash flow will shift towards the positive in the months and years ahead. Although IPOs are generally a relatively small proportion of total exits, they are high profile, and I think they help to generate interest in private markets. We are seeing signs of a recovery in the IPO market, particularly with rumours that Shein, our largest holding on a look-through basis, is considering an IPO. Shein is a China-based fashion business which has grown into a global giant, frankly, and emerged from a portfolio of secondary positions that we purchased some years ago. We're also aware of some other businesses in HVPE's portfolio that are considering IPOs in the year ahead. And so that's an encouraging sign that realizations may tick up. There will be positive news flow around the portfolio, which will help to reignite interest in HVPE and its shares. We made new commitments of $295 million in the year. That represents a significant scaling back of the original commitment plan. We took that step in recognition of the negative cash flow that we saw during the year. We never lose sight of HVPE's long-term investment approach, which is to try to achieve a balanced vintage by vintage exposure, which over the long run we found is the best way in practice of optimizing NAV per share growth.
HVPE gives investors exposure to the very best managers in private markets around the world. And right now we're at potentially a turning point in global interest rate cycles and in economic activity. If we see a pickup in IPOs, initial public offerings around the world, if we see a pickup in merger and acquisition activity, then this will flow very directly into returns to private equity investors, and HVPE shareholders will benefit as a result. So I'm very excited as I look through the coming year that we are on the cusp of that turning point, and I believe that this company will continue to deliver excellent long-term returns as it has done ever since inception.